Okay, welcome everyone. Thank you very much for joining us today. I'd like to welcome you to SHARE's fourth and final online religious investor workshop of 2020. My name is Effie Slapnicar and I will be moderating today's session. And I'm very pleased to be with you today. So I am the Bursar and the Chief Administrative Officer at the University of St. Michael's College, and I am responsible for the administration of the college's endowment. So as a result, I look forward to today's discussion to help me better understand how religious and other investors can measure their progress toward investing in a just and sustainable way. This video conference brings together more than 50 investor representatives of religious communities, denominations, parishes, pension funds, endowments, and educational institutions. During the next 90 minutes in plenary and in small group discussion, we will explore this important topic. So to start off our session, I would like to invite Chung Lam of the Evangelical Lutheran Foundation of Eastern Canada to offer an opening prayer.
Thank you, Effie. I invite us to take a minute, take a deep breath, center ourselves, and begin with prayer. God of abundance and care, you have poured out a loving and generous measure of earthly blessings before us. Our tables are furnished, our cups overflows, and we live in safety and security. Turn our hearts to the corners and concerns around us, with our neighbors and strangers, where shelters are wished for, food and drink are begged for, and safekeeping is a distant dream. Teach our hearts and minds to work for the common good of all humanity and creation, where justice prevails over competition, compassion over profits, service and community over self and individuals. We keep in our prayers all who are impacted by COVID-19. Bless the frontline workers, the essential workers, and especially our leaders, both in the church and other levels of the government, to be resilient for the sake of a world in need. And especially today, we ask you to bring wisdom and insights to this session, and especially to the work of SHARE as they are partners with us and lead us to be a hope in the world. We pray in Jesus' name. Amen.
Amen. Amen. Thank you, Chung, for getting us off to a great start. So our workshop today has three parts. We will start with a panel discussion, followed by a small group discussion, and we are going to end with a conversation with Melissa Kennedy, Vice President at Sun Life and a member of the Ontario Task Force on Modernization of Securities Regulation. Please consult your agenda and speaker biography sent to you earlier this week for additional details. So your videos will be turned off for the for the panelist section, but they will be turned on during the small group discussions. If at any time you experience any problems with your signal, try turning your video off. Now, before I introduce our panelists, I want to mention a few housekeeping items. During the panel discussion, we will ask you to vote on a few key questions. A dialog box will pop up prompting you to select an answer, and you will have 15 seconds to respond. So we're going to test this out right now by asking our first question. What type of fund do you represent? Okay, so here are the choices. So please select one of the choices and hit the submit button, and you'll have 15 seconds to do so. Okay, and here are the results of our poll. So at 42%, we have religious and community congregation, and that is followed by a pension fund and a local or regional church or body. So that should come as no surprise given that this is a religious investor workshop today. So If you have any questions for the panel, please click the text balloon icon at the bottom of your screen. This will open up the chat icon and you can type in your questions and I will do my very best to bring them forward during the discussion period. So it is now my pleasure to introduce you to our panel. Yulena Wan is the Director of Finance and Operations at the Hamilton Community Foundation. At the foundation, her responsibilities include the administration of a $200 million endowment, and Yulena is also a board member at Share. Michelle Sayed is an analyst at Share. Her work focuses on data analysis, and she is a key member of the team that generates proxy audit reports for institutional asset owners. Darren Smith is the president and the chief investment officer at the University of Toronto Asset Management, where he is responsible for the investment of assets valued at more than $10 billion. Darren has overseen a significant increase in UTAM's attention to environmental and social issues, and he also serves on the investment committee of the Salvation Army. And last but not least, Shalini Ramgulam is the program officer at Share, where she supports programs related to the stewardship of workers' pension funds in Canada and internationally. So Darren, we'll start with you. Before we explore the issue of asset manager accountability, can you give us a picture of the University of Toronto Asset Management, or as it's more affectionately named, UTAM?
Sure, happy to do so. And thanks for inviting me to share our thoughts on responsible investing. So UTAM was founded in 2000, so it's been around for quite some time. As Effie has mentioned, we manage over $10 billion on behalf of the University of Toronto. Those assets represent pension assets, endowment assets, and operating assets for the University of Toronto. We have about 30 people on staff with 11 people on the investment team, and we invest primarily through third-party external managers.
Thank you, Darren. So even though you are a much larger organization than most of the funds that are attending this workshop, can you share your experience of using external managers? Tell us about your approach and how you work with external service providers.
Sure, happy to do that. So maybe I'll just give a bit of background first on our overall approach and what we're doing, and then I'll dig into what we're doing with our managers and how we use service providers. So responsible investing is extremely important to us at UTAM and to our client, the University of Toronto. We really embarked in earnest on our current approach starting in 2016. Leading up to that point, there was a fairly significant divestment campaign on campus with respect to fossil fuel related companies. So at the University of Toronto, there was a process for moving that petition and the divestment request through governance. Ultimately, after a series of working groups and reports were presented, it was the president of the University of Toronto who ultimately was the decision maker with respect to divestment or not. And at that time, he determined that broad-based divestment was not the approach that he wanted UTAM as the University of Toronto's investment manager to adopt. However, what he did say though is that he wanted us to consider ESG factors in our investment decision-making process. And so as part of that, I've been at UTAM now for about 12 years. So I've really been spearheading our responsible investing efforts. And as I indicated, most of our investments are through external third-party managers. So, first of all, we had to figure out, what was best practice for incorporating ESG considerations in an investment program that was primarily investing through third-party managers. So we did a lot of research. We networked with peers both in Canada and globally. We talked to various service providers. So one of the first things that we decided to do was to sign on to the UN-supported Principles for Responsible Investment. We thought they were a great organization. We continue to believe they're a great organization. So we supported their 6 principles, and that forms the cornerstone of our responsible investing activities in terms of the high-level principles. Now, if we look specifically at managers, so we have always spent a lot of time with our managers. We don't outsource that to consultants. So I mentioned earlier, we have 10 or 11 people on our investment team. So we're speaking directly with the investment managers. And so we'd always spent a lot of time with them, but now we now have this additional lens through which we're evaluating managers, and that's this ESG lens. So some of the things that we do would include asking managers for their entire list of holdings every month end for the last, let's say, 10 years, if the managers had that amount of history. And then we've invested a lot in systems and tools that allow us to analyze those holdings. So what we can do is we subscribe to data through MSCI. There's lots of other data providers, but we get the E, S, and G and composite ESG scores from MSCI, and then we match those up with the positions in the manager portfolios. So what that allows us to do is actually go through the manager portfolios, figure out names where there might be E, S, or G concerns, and also opportunities. And then we try to be pretty smart about how we approach managers. So we don't just go and ask them about names that, it's obvious that they're ESG concerns, because one of the things you have to be really careful with now is there is a lot of greenwashing. Lots of managers are saying they're doing certain things. And then when you dig into the details, you realize they might not be doing exactly what they're telling you. So, of course, we review their responsible investing policy. We will talk to the people, the investment people, if they've got a dedicated responsible investing team, we'll talk to them. But beyond that, we feel it's really important to do our own homework. And so we've invested a lot in technology and data. And so we'll do a lot of our analysis ourselves. And then what we'll do is we'll go to the managers and say, okay, we want to talk to you about company XYZ. And we've already done a lot of homework. We know what the potential ESG concerns are. And so what that allows us to do is have a more informed conversation with the manager because we've already done our homework. And so what we're looking for them to do is to recognize for these names where we believe there are potential ESG risks, that they are aware of those concerns, that they've taken them into account. I should have said earlier on, we do take an integration approach to responsible investing, which really follows what I just mentioned. We expect our managers to be aware of these considerations, to take them into account. And so we have a good dialogue with the investment managers about this. And so, there are other things that we will look at, including, what type of reporting they provide. But because we have access to the individual portfolios of these managers, we can do a lot of work on our own. So what we think that allows us to do is ask more informed questions of the managers and just have a better idea of what they're actually doing. So there's lots more I could say about this. We're super excited about what we're doing. It's really important to us. What we do with respect to our investment managers is one part of our comprehensive responsible investing approach. The other parts would include what we're doing on the stewardship side. So where possible, we've taken back voting from our managers. So if we have a segregated account, we spent a lot of time thinking about a policy or guidelines that we wanted to follow that were more ESG friendly. So we don't just accept whatever the manager's voting policy is. Where we can, we decide what voting policy to use. Also, with respect to stewardship, we do an awful lot on the engagement side. So we've joined groups like Climate Action 100 Plus, that is an investor-led initiative engaging with over 100 of the largest global greenhouse gas emitters. So we're participating in direct engagement with some companies there. But you asked earlier, Effie, about how we interact with service providers. We have, in this case, engaged a third-party service provider to engage with companies on a global basis on our behalf. So there are a number of great providers like Share doing that. We happen to use Hermes. They have a lot of larger institutions that use their service. And so I think one of the themes in our approach as well is that even though we're managing 10 or 11 billion for the University of Toronto, it's obviously extremely important for them. In the grand scheme of things, we tend not to represent a very significant proportion of any one company's equity. So we try to team up with other like-minded institutions wherever we can. And so, Hermes, that's another example. Canada Pension Plan uses them. And so these engagements are taking place on all of our behalfs, and so we benefit from the combined influence that we may have. And then in addition to that, of course, we do think about our communications and transparency. So on our website, we have a dedicated section for responsible investing, and we include a lot of information in terms of what we do. It includes our responsible investment policy. I guess the last thing I'd say before you ask any other questions would be, it's really important from our perspective that we have investment people talking to our managers. What we find is that in some cases, the managers know it's really serious when you've got the investment team talking to them. Sometimes if it's just people that aren't part of the investment team, and maybe there's a bit of a disconnect between a dedicated responsible investing group at an organization, it's a little bit easier for the managers to think, well, maybe this isn't so important. And so I spend a lot of my time on this. I engage with managers quite frequently, and we've had a lot of success with managers, joining the PRI, doing more from an ESG perspective. So, part of our engagement is actually engaging with managers.
So thank you, Darren, for that. You mentioned greenwashing, and I'm sure that UTAM has you mentioned that you have several tools and ways of really analyzing a lot of the information that is being sent to you. What can some smaller institutions do in order to, determine this could be greenwashing? Are there any red flags that you've seen over the years?
Yeah, I think it can be tough, because managers all have a story that they want to tell you. And, a lot of investors are talking about ESG considerations. So managers have a pretty good idea of what they think you want to hear. So I would say, wherever possible, you want to, either through a consultant or, your in-house staff, try to dig into the data. Yeah, of course, you need to review things like the responsible investment policy and talk to the relevant people. But, things really come alive when you talk about individual positions. And so, you could ask managers, again, if you don't have the resources to get all the holdings yourself and do the analysis, you could ask for case studies, for example. So you could say, give me some examples of positions that are in the portfolio where ESG considerations were a material factor in your investment process, and get them to walk you through that. Now, it can be a challenge, right? Because they're going to cherry pick, they're going to pick examples that are favorable to them. So still, it's better than nothing. Other things you can ask them to do is with respect to reporting. So you could ask them, for example, to provide the carbon footprint of the portfolio. You could ask them if they subscribe to any data sources with ES or G data, and maybe provide the aggregate portfolio score on the environmental, social, or governance side, or the composite side. So where possible, yeah, try to push back to managers and say, they're the ones with the holdings. What type of reports can you provide to me that would evidence that you're actually doing what you're telling me you're doing?
Thank you for that. We do have a question from our chat. Darren, do you rate your managers using a standard scorecard, or do you have a different way to measure for different types of managers? And are there any consequences or corrective actions when a manager is not measuring up?
Right. So as part of our due diligence process, we'll spend, in some cases, 50 to 100 hours with the manager. So this can be a long process, could take months. And so as part of this process, we write up a recommendation memo. So manager hiring and firing decisions have been delegated to a staff at UTAM. But we put together this document for internal purposes, and it goes to our own investment committee. So as part of that, we do include a dedicated section on responsible investing. And we do rate managers from an ESG perspective. So, there's certain things that we're going to be looking for. So, are they signatories to the PRI? If not, why not? If you are, let's look at your assessment report. And another thing that you can ask managers for, it's not good enough anymore that a manager is just a signatory to the PRI. That's nice, and we certainly encourage our managers to become signatories. But again, the devil is in the details. And so, one of the things you might want to ask for is their private PRI report, which includes all of their answers to every question that the PRI has asked. So you'll be able to tell, well, why has a manager only scored an A or a B or a C in these different categories? So anyway, in terms of our investment due diligence report, we do rate managers. There's certain things that we look for. The reality is that depending on the particular asset class, some asset classes are more advanced than others with respect to responsible investing. So for example, we find that generally public equity managers on average are doing a bit more and they're more familiar with responsible investing. I'd say, on the opposite end of the spectrum would be hedge funds, and that's often, a different conversation. But one of the things that we try to recognize is that what we expect from a manager and what we think best practice is with respect to ESG does depend in part on the investment strategy. So we believe that the investment holding period, for example, is very relevant. So if you're a private equity manager, and let's say it's a buyout fund where you're taking a control position and you're expecting to hold that investment for 4 or 5 years or even longer, we think that there are many ESG considerations that are very relevant for a longer holding period like that, where you have control over the company. So we do tailor the questions that we ask managers, and in terms of what we're looking for, depending on the particular investment strategy. We don't believe there's a one size fits all. There obviously are some common elements. We would expect all managers, or we would encourage all managers to sign on to the PRI, to have a responsible investing policy. But when you get down into the details of like the investment strategy and how they're evaluating companies, the types of questions that we would ask are different depending on the strategy. And sorry, just briefly, you sort of mentioned, are there consequences? Absolutely, there are consequences. So we spend a ton of time with our managers up front, really understanding what the current state of play is. We're going to take a view on what we think they're actually doing, not just what they're telling us they're doing. But we're also using that as an opportunity to engage with the manager and tell them, what's really important to us and our client. And if you can somehow tie that in with why it should be important to the manager beyond just marketing. And our view is that many of these considerations are material. And so, part of this is a bit of an educational process, and we can talk about specific names with the managers and say, hey, these are material ESG risks. We think, it should be very important for you to be aware of them and to take them into account. And so, over time, it does mean that right away, we don't need a manager to already be following best practice. That would be ideal. But the reality is that there is a spectrum. And so we will work with our managers and we'll document, here's where a manager is now, here's where we'd like them to get to, what's the trajectory. And then we're constantly revisiting this. So we'll typically have quarterly touch points with our managers. Not every conversation is about responsible investing. One thing is, the reality is that not only do we as investors have limited time, managers have a limited amount of time they can spend with you as well. So you really have to be targeted and thoughtful around what you ask them. But the bottom line is that we are tracking, our managers and how they're evolving over time. And we have redeemed from managers where, they haven't been able to progress as we would like, or they haven't been willing to engage with us. But I would say that we've had great success working from the inside as investors to have managers sign on to the PRI, really evolve their investment processes. And we think that's great because it benefits not only us, it benefits the manager, and it benefits all of the manager's clients.
Thank you, Darren. So there's some more questions that are coming in through the chat, but we'll circle back to these at the end of the discussion. So for Yulena and Michelle, proxy voting is powerful, but too often it is an ignored tool for investors to influence the corporations that they invest in. Hamilton Community Foundation has pioneered proxy audits with Share and has been conducting them annually for the past 5 years. So now, before I ask you to tell us about this, we're going to ask our workshop participants a second question. So the poll box should pop up any moment now. And the question is, who votes your proxies? So if you could just select one of these responses and hit submit when you're done. Has everyone had a chance to vote? Okay, here's the results, and I'm really not surprised at all. So our asset manager votes for us is the number one answer. Second is our votes are cast by proxy voting service, and then that follows by I don't know. So that's a little bit more concerning. So for Yulena, why did you decide to make proxy audits part of your asset manager oversight?
Thanks, Effie. So both of our managers, as Darren spoke about, are signatories to the UNPRI, so the United Nations Principles for Responsible Investment. And we see our proxy audits as a kind of custodial way of checking on that. So just as we have investment managers, we have a custodian that provides that kind of extra level of security and verification. It's the same for our proxy voting audits. You know, as kind of Darren alluded to, it's fine for them to sign on all to these various groups and declarations that are out there. But this is one way that we can kind of ensure that that commitment translates into how they operate and vote on our behalf. And so we kind of see it just as good governance. Like many of the organizations in our audience today, the Hamilton Community Foundation is a very values-driven organization that aims to carry out its work and mission across all parts of the entity. So my team working in finance and operations means that one of my overarching goals is to align all of our assets with our mission. And for us, you know, that it's not enough to invest our endowment so that we can support our community and just make the maximum return at any cost. We need to ensure that those investments are being made in a way that's aligned with our values, our investment policy, our priorities. And so proxy voting audits allow us as management, as well as our finance committee and our board, to monitor how our proxies are being voted by our managers, particularly on issues such as you know, board diversity and climate change, workplace safety, executive compensation, all those really, really important issues. Perhaps down the road at some point we'll have the resources like you, Tam, and capacity to develop, you know, our own proxy voting guidelines and maybe even vote them ourselves. But for now, this was kind of our starting point in our very long evolution to learn and understand the proxy voting power that we hold, and also as a really effective way to kind of teach and bring along our finance committee and board on that learning journey with us.
Thank you. So Michelle, can you describe what is involved in a proxy audit and what is the process and what information is included in the report?
Great question, Effie. And before I dive in, I want to thank you for inviting me to speak on the panel today. And I'm excited to talk to you about the proxy audits and the work I do. So the audits generally break down and analyze asset managers' voting records in a way that is clear and easy to understand. The aim was to provide asset owners with more information on the following three areas. The first being how their shares are being voted. And in cases where more than one asset manager is audited, we look at how closely their voting records align with each other. So in other words, are your votes being canceled out because your asset managers are voting in opposite ways on the same proposals? The second thing we look into is how closely asset managers follow the voting recommendations of corporate management. And here we determine if managers evaluate each proposal separately or if they just vote unanimously according to corporate management recommendations. And generally, management tends to recommend voting for the proposals they put on the ballot and against shareholder proposals. And the third thing we look into is we compare the asset manager's voting records with that of overall shareholder sentiment on key proposals. Now, these would be on proposals that were either strongly opposed or supported by shareholders. For example, earlier this year, there was a shareholder proposal filed at Restaurant Brands International seeking improvements to the company's performance on decent work and human rights. And even though the company is majority owned by 3G Capital, the vote received strong support among independent shareholders, signaling to the company their dissatisfaction.
So what does an investor learn from a proxy audit?
I just covered that, but mostly
Is there anything else that they can learn? I guess I'm a little shocked to hear that, you know, you can be, when you outsource this, you can be voting against certain issues, and that's, I do wonder now if that has ever happened to us at St. Mike's, and I'm sure others as well. But are there other things in addition that we can learn from this?
There is a lot, and I can spend hours talking about the great details of different votes and how they played out. But to keep things general, what I will say is the way proposals are worded plays a big role in how asset managers tend to vote on them, especially if they find the proposals to be too prescriptive, which would generally mean they would vote against the proposal. But again, there's something else that has really shocked me is there's a lot of inconsistency within the same topic that they vote on. So say there's a board diversity proposal at 7 different companies, they're going to support 3 of them and then vote against 4. And so even though it's similar shareholder proposals, it's not consistent throughout. And that would be one of the most glaring things, also alongside with asset managers voting in opposite ways. So inherently you're just voting against yourself.
Mm-hmm. Thank you for that. Yulena, now that we have a better sense of what a proxy audit is, how do you use your audits and how is this helping you?
Thanks, Effie. So very consistently with what Michelle's just spoken about, there are many layers to how we use the results of our proxy voting audits. Luckily, we have the help of the fantastic share team, Peter, Michelle, et cetera, to help us with that. And my goodness, it's such a complex area. And that's why it kind of builds the beginning of that learning journey that I spoke about before. So just some of the things that we come to understand are things like, what are we voting for and against? You know, for instance, on those different priorities that I and both Michelle spoke about earlier, are we voting with an independent voice? You know, how often are managers voting with or against the corporate management recommendations with shareholder resolutions? Are we voting consistently? Which certainly when I first heard as well was one of the like, wait, what? You know, when both of our managers hold the same security, you know, we're able to compare now whether they voted the same way or whether they've split it, in which case we are just canceling our own vote and not doing anything, right? So I think that's a huge one to know and be aware about. And then I think also one of the most important pieces for us at the Community Foundation is how does our voting compare over time? So not only are we able to compare our results against a benchmark, but we're also able to analyze our investment managers voting over time now with historical results over the last 5 years. You know, managers fall all across the spectrum on their kind of their own ESG, environmental, social, and governance journeys. And it's helpful to see how they progress or regress over time. A really kind of concrete example I can think that may help solidify it in people's heads is a few years ago, we had a manager who was taken over by a big bank. And we worried a little bit about whether the big bank mentality might impact the philosophy of this formerly kind of small values manager. And so it's through our results that we were able to see definitively if there have been any shifts in their approach. That was super, super helpful for us. Something else we've been told by our managers is that it's very unusual for them to see the audit results. And so we felt like it's a no-brainer to share it with them. You know, in the spirit of full transparency and learning together, we flip over the results when we get them, and we invite them to join our finance committee meeting to discuss the results with us. And you know, for us, it doesn't feel like there's much value in us talking about it as a committee in a silo separate from them. Instead, we're kind of you know, we've normalized these sometimes challenging conversations and started dialogues with them. So with that being said, we do not have all of the answers by any stretch of the imagination. If I've learned anything when it comes to ESG and responsible investing, that it's very, very, very gray often. It's very complex. And as our organization learns more, our managers are able to come along with us on this journey too, particularly if they're developing their strategies. And so it's a bit of a kind of shareholder or a client education, I suppose. They know that we're going to hold them accountable and ask them the tough questions. And we've seen their attitudes and engagement change over time, actually. And by no means do we think that is solely credited to us. I need to say that. But to the point where they're presenting to us on their responsible investing strategies and their corporate engagement over the year at every meeting with us. It's a standard part of their reporting. Not just, that one time a year where they come and speak to us at our meeting about the audit results. So instead, our organization's commitment to responsible investing has really encouraged them to bring forth the information that in a really proactive way and influence the kinds of conversations we're having with them that we definitely would not have seen 5 years ago. So I would definitely encourage you to share your audit results with your managers and start those conversations.
Thank you. That's a very interesting point. Thank you for that. So for Shalini, I have a couple questions for you. Most participants in today's workshop are not familiar with the Global Unions Committee on Workers' Capital, or sometimes it's referred to as the CWC. Can you take a few minutes and introduce this to us?
Yeah, no problem. First of all, happy to sit on today's panel and share the CWC's model of asset manager accountability today. So the CWC, or the Committee of Workers' Capital, is a global network of worker-nominated trustees and labor union representatives that are committed to the responsible investment of workers' capital. So we connect about 700 participants from 25 different countries across North America, Europe, the Asia Pacific region to promote information sharing and joint action in the field of workers' capital. So mostly, the focus of our activities is to mobilize workers' capital and to raise the bar on labor issues in particular through the investment chain.
Thank you for that. And in recent years, the CWC has focused on asset manager accountability. Recently, it started organizing meetings between fund managers and groups of funds using that asset manager. Can you tell us a little bit about these meetings and what asset managers get out of it?
Essentially, the CWC, we launched our Asset Manager Accountability Initiative in 2019 to support trustees and unions in raising workers' rights issues with asset managers. So kind of building off what the previous speakers have said, it's really become clear in this space that the needle on ESG issues really won't move forward without the support of these large intermediaries and asset managers. So, BlackRock, Vanguard, State Street, like these big names, they wield a substantial amount of power in the investment chain where they aggregate significant amounts of capital and concentrated ownership stakes in almost all publicly listed companies. So, for example, in the US, the big three represent the single largest shareholder in at least 40% of all listed companies. So, these asset managers have become increasingly important to the success or failure of any shareholder resolution, and they hold a substantial amount of power in the public policy context as well, when they weigh in on these different policy consultations regarding investment regulations. So that was really the real reason why recently the CWC has been focusing more and more on this notion of asset manager accountability. And essentially, the goal of this initiative is to shift, the balance of power in the investment chain away from these asset managers and back towards the true owners of capital, which in our case would be the workers and their pension savings. So I can tell you a little bit about our model to achieve this. In brief, the CWC's Asset Manager Accountability Initiative can really be broken down into two stages. So the first stage is about this creation of a report. And then the second stage is about organizing this collective meeting with asset owners. So, in the first report stage, it's really about research, doing your homework, like Darren mentioned, and information gathering. So we've identified 10 global asset managers that we've committed to create a report on. And in this report, we really do a deep dive to examine their overall ESG and RI policies, their engagement priorities, their proxy voting guidelines, public statements, even some submissions to recent public policy consultations to really get a sense of how they address labor rights in their stewardship of assets, either public and private, actually. as it relates to labor rights. So while we're doing this exercise, we also tap into our network to bring forward, specific trade union priorities from around the world. So for example, if there's a shareholder proposal on labor rights at this specific company, we'll include it in our report and track the asset manager's voting record on that specific issue. So in the last report, for example, I think we tracked like 10 to 15 different vote results. And so typically what we find when we do this exercise, and it's not surprising, as noted from the previous speakers, but there is truly a major contradiction from these asset managers in terms of what they say they are doing in their policies and then what they're actually doing in real life, and from these cases that are brought up from our contacts, from our trade union contacts. So, now that we have this whole big research formalized into a report, in the second stage, what we do is, we engage with the asset manager on this. So we'll bring the report forward through our network to kind of coordinate this coalition of trustees, pension funds, and others to really press the manager on the findings of the report. So for example, last year, we had a sit-down meeting with UBS in Paris, where we had, this coalition of international asset owners from Australia, Finland, the US, Canada, the Netherlands, and others to come together and engage this one asset manager on these collective issues. And so the goal here is to really raise awareness on these specific issues and really to get them to see, our views, our values, recognize that, this isn't just a one-off. This is not just one organization that thinks this. This is a global coalition of people that are all coming to you with the same priorities, with the same concerns. And so, yeah, we've done this about 3 times, and there is a real power, I would say, coming out of these meetings. There is real value in the collective engagement. There's value in this messaging coming directly from the clients, not just, Joe Blow, but, from the clients of these asset owners. And yeah, definitely a real value in raising these issues together as a group.
Thank you. So I have a number of follow-up questions for the panel. I'm going to begin with Darren. So Darren, can you just talk about some best practices for asset manager reporting to asset owners or responsible investment, and what should investors expect?
Yeah, great question. Obviously we try to do a fair bit of our own work, but we also ask managers to provide reports, and for those that aren't able to analyze the positions on their own, I think there are certainly some things that you can ask managers for. So for example, different reports might be, and I mentioned some of these earlier on, but I guess first you have to figure out what's really important to your organization, right? And then make specific requests to the manager. So for example, maybe climate change is really important. So in that case, you might ask the manager for the carbon footprint of their portfolio. So like the carbon emissions that are represented by the companies in their portfolio. If a manager says that they're doing a lot of ESG work, it's like, okay, well, how are you doing that? Are you doing your own independent work? Are you rating the managers yourself? Are you using an external provider to do that? But if they've got ratings, it would be helpful to, again, maybe this case study idea, let's see some of those ratings, and maybe the manager can provide a composite score for their portfolio. But I think, the composite score would only be the first step, because I think you really do want to look at specific names in the portfolio wherever possible, because that's where we find a lot of the nuance actually comes out when you start moving beyond the generalities and talking about specific holdings. So I mentioned before, it's great if a manager is a signatory to the PRI. And of course, we'd look at their scores, but ask the manager for their private report, which, as I indicated earlier, that has all of their responses. So you can actually get a much better idea of what they're actually doing, or at least, again, still what they say they're doing. In addition to that, there are a lot of publicly available resources out there. So, it's not like there are other organizations beyond the PRI. I mean, I know I talk about the PRI a lot, and it is a great framework, and there's, thousands of members and they provide a lot of research, but there's other, great organizations like Share and other groups. But there are different DDQs that are available. So I think AMA has one, ILPA on the private market side has one. There's different templates that these, organizations have put together. I completely agree with, with the other speakers in terms of, trying to work together to affect change. So, different coalitions or different groups, because the reality is it's even for the largest investor, it's going to be really difficult on their own to affect meaningful change. But the more of us that are asking managers about this, and that includes asking for specific data, like managers get it. If enough people are asking for something, the chances of you getting it are just so much higher. Because what I find still is many cases people will say to me, well, Darren, nobody else is asking for this. You seem to be the only one that cares about it. I'm like, that just can't be true. There's just no way. And so, be thoughtful around what's important to you and figure out what type of information would be helpful. So, it could be as simple as, maybe there's a particular investment that you have concerns about. So you can talk to the manager about that. Ideally, what you'd like to see potentially are certain key performance indicators that the manager may track for specific holdings. That's often more relevant on the private market side, but you want some idea of, what they're expecting of their companies and how they're tracking that through time. So one, I'd say, think about different coalitions. I think there are a number of groups that are trying to figure out some standardization in terms of the reports that they want managers to provide. Because if I've got my own customer report and there's hundreds of other groups with their own customer report, I mean, it's overload for a lot of these managers. So of course, we're not always going to agree about everything, but I think there's a lot of things that investors would have in common that we would want from managers. So any effort to standardize reporting requests, I think would be really helpful. So again, if you're using a consultant, talk to your consultant, make sure you really understand what they're doing, ask them, try to figure out if they're asking the right questions. And if they're part of the conversation, trying to move managers along, or in some cases, I believe that consultants could just say, I'm just going to report what the manager does. They're not necessarily going to encourage the manager, to do more, for example. So, those would be a few thoughts on the different reporting angles. And I guess the last thing too, just on, I know we were talking about voting. So one of our pet projects is, I said we've taken back voting where we can, but the reality is we do have a lot of investments in pooled funds. So, that's where we've got lots of other investors in there besides our client portfolios. And so we may have different views on, the importance of ESG, for example. So what we ideally like to do is instead of, if the manager's just got a regular voting policy, ISS or Glass-Lewis standard or benchmark, and we want to use a more ESG friendly policy, we actively talk to our managers and say, look, can you split the vote? If we're 10% of your fund, and we want you to vote according to, some more ESG friendly policy, will you do that? And it's just another example where managers are like, first of all, oh, we can't do that. It's not possible. So we reached out to ISS, Glass-Lewis. Of course it's possible. The managers generally, would prefer not to do it because it's more work. But it was interesting because actually through this conversation leading up to it, I did find out that this is a big initiative in the UK where, this is actively being discussed. And, back to, we as the owners of the assets are providing the capital to managers, we are ultimately the owners, even if it's indirectly, of these securities. And so to the extent that we can have more influence, how these are voted, I think that would be, tremendous. And it's just another example where collaborating, with our like-minded peers, we just have a better chance of making it happen.
Thank you, Darren. Shalini, did you have something to add to that?
Yeah, so maybe I'll just kind of echo Darren's remarks and say, I completely agree. Like the more asset owners approach their asset managers on this specific issue, the more likely we'll be able to kind of shift that balance of power in the investment chain, and the more likely asset managers would, disclose more information, adhere to our values, et cetera, et cetera. So in our approach with the Asset Manager Accountability Initiative at the CWC, the way that we'll engage with these asset managers we'll approach them with kind of like two bucket of asks, essentially. So we have these like broad policy asks, and then we also have these very like specific, like company specific asks. So, you know, when we go through our their guidelines and policy documents, et cetera, like I can give you the example of BlackRock. So recently in October, we've released our report on BlackRock stewardship policies and practices. And in going through all of their documentation through this like labor rights lens, we found that, you know, our major policy ask from them has been that they really don't address labor rights in the way that we'd like them to. So you'll see a lot of talk about human capital management, for example, and that's kind of the framing that has been adopted by SASB and others on like human capital management. And it's more of like a materiality lens. But then from our perspective, we're really hoping to shift BlackRock's framing of this issue in their engagements and their proxy voting practices, et cetera, to more of a like fundamental labor rights frame, to more of a human rights frame, where, you know, you're looking at these broader things of you know, collective bargaining and freedom of association, and you're looking at like indentured workers and slavery, like these big broad issues that you can kind of address in a more holistic way. And at the same time, so, you know, you kind of approach them with these big policy asks and we say, you know, hey, this is the framing that we would like you to adopt. Here are some international frameworks that you can adopt. But then to complement that, we kind of also bring very specific case studies or very specific examples from our network to say, you know, we have a very big Amazon campaign going on right now. So we'll say, hey, on Amazon, we've developed the shareholder proposal with these specific issues. Will you support it? So I think kind of when you engage in these meetings, having a balance and a broad range of asks, going from like the big bold asks to these like very specific concrete examples is very, very helpful.
Thank you. And question for you, Yulena. The Hamilton Community Foundation has made a commitment to responsible investment. What are some other strategies you're using, and how does proxy voting fit in with your overall approach?
Great question, Effie. So I guess going back to my comments earlier, our goal at the foundation is to align all of our assets with our mission. So we don't just mean, you know, the CRA disbursement quota of 3.5% of our assets, but we mean, you know, 100% of our principal that makes up our $200 million endowment. So we recognize that all of our investments, whether it's our public portfolio or our impact investing portfolio, have impact, and that they can be powerful tools to accelerate achieving that vision and our mission. And this means challenging the premise that our investments are only a means to generate income that funds are granting in our operations. So as I think Darren has spoken about, another tool we use is in our RI strategy is our ESG audits. So, you know, every investment will have some impact. We know it's going to be positive, negative, neutral to some extent. And so we engage with Sustainalytics in our ESG audits of our portfolios to determine what the environmental, social, and governance impacts that our holdings are having. And just like proxy voting audits, we've been told from our managers that they very rarely get these results. And for the same reason, we share them and start that discussion so that they can understand where we're coming from. You know, our investment policies can be, they can be really detailed, and certainly they won't always, you know, cover every instance. But when your investment manager understands where you're coming from and kind of, you know, what your goals are and how you want to achieve those goals, it creates this kind of partnership that's more than just, you know, a vendor-client relationship. So just like the proxy voting audits, you know, we've built up these historical results over the last 5 years, and we can see how our managers have progressed or regressed over time. In addition to that, we also use exclusions in our investment strategy. Currently, we only have 3. We have tobacco, illegal weapons, and predatory lending that we exclude from our portfolios at this time. And we've tried to really use them in a limited way, perhaps only as a last resort or in extreme cases. We've taken the stance that exclusions really prevent us from having any further voice through proxy voting or any sort of shareholder activism. And once you're out, and you no longer have a voice to influence as a shareholder, which kind of, I guess, brings us back full circle to proxy voting. We see our proxy voting as just one tool in a toolbox full of different ways we can influence and measure, grow, and learn and evolve with our managers when it comes to our impact.
Thank you. Thank you very much. I really want to thank our panelists. And next, we are going to break into groups of 8 for 15 minutes to discuss today's theme and the presentations from our panelists. Zoom will assign you to a group. And once you arrive, please introduce yourselves, and you are going to discuss 2 questions. The first is, what is an example of a positive experience working with your asset manager or other service providers on aligning your mission and your investments? And the second question on the flip side to that is, what is your biggest challenge you face in working with your asset managers on aligning your investments to your values, beliefs, and mission? So when you return, please share your small group discussion on the chat space. Good luck, and we will see you back here in 15 minutes. All right, welcome back, everyone. I hope you've had an opportunity to meet some of your colleagues and exchange your experiences. As a reminder, please provide a number of points in the chat box, and I'm sure we'd be happy to read them and learn from everyone here on the call. So the final section of our workshop is a conversation between Share Chief Executive Officer Kevin Thomas and Melissa Kennedy. Melissa is a senior executive at Sun Life and recently was a member of the Ontario Task Force on Modernization of Securities Regulation. Before we turn to Kevin and Melissa, we have a third and final poll question for you. So if you could please complete the following questions. So securities commissions should require public companies to do the following. So please check please check a response and then hit the submit key at the bottom. I'm sure the response will pop up any second now. Here we go. All right, so number 1, provide enhanced environmental and social disclosures. I mean, that is, again, not a surprise considering the topic that we're discussing today, followed by setting targets for board gender and racial diversity, and then say on pay votes for executive compensation. So very interesting. So I would like to turn the floor over now to Kevin and Melissa.
Well, thank you so much, Effie, and welcome, Melissa, and thank you for joining us. I'm trying to think where to start because, okay, so the Ontario Capital Markets Modernization Task Force, it issued its draft report in July, and I think you're expected to release a final report any day now. It had a mandate. The mandate of this task force was to make recommendations to modernize Ontario's capital markets regulation, clearly. And you're reporting back to the Minister of Finance here in Ontario. Looking back, you met, I read your first report, and you met over 110 stakeholders. We put together a coalition of large pension plans, asset managers, and banks at Share, and met with you, and we're grateful for that opportunity. And then you put out a report with about 47 recommendations. We have about 20 minutes, so I don't think we're going to get to all of them today. But part of this was a result, it was like, what, 17 years ago that we had this kind of review. That was the last time that there was anything like this. So there's a lot of ground to cover. And I think in the meantime, capital markets, I mean, maybe what I want to start out with is, has the view of capital markets, how they function, where they don't function, has that changed over that time? Like what's different than in 2003?
Well, first of all, I just want to say thank you so much for inviting me. I came in a little early And I was very interested in the discussion. ESG and sustainability is near and dear to my heart because I'm the executive sponsor for sustainability at Sun Life, and I used to be quite involved in it when I was general counsel at Ontario Teachers Pension Plan. So, but on both sides. But sustainability and ESG matters are a passion of mine. So part of my work seems to be on the capital markets task force. Yes, you're 100% right, Kevin. The last time we looked at the Securities Act and the capital markets was a Pretty Crawford report, which was issued in 2003, which is a couple of crises ago. So we have met actually with hundreds now stakeholders since June. We're continuing to meet. I've got actually 2 more meetings after this about it today, and thousands, literally thousands of people. What's different about the capital markets? Just about everything. When we were initially starting to meet with people, and we were asked by the minister to take on this important work in mid-February, and so pre-COVID, little did we know. But one of my colleagues, there's 5 of us on the task force. One of my colleagues would always end, the first meetings with asking, okay, if there's one big thing you would change, what would it be? And we quickly turned that into, okay, tell us the 3 dozen things you want changed. So we're now over well over 80 recommendations that we're working on, because it literally is everything from soup to nuts to, how information is disseminated. In 2003, we didn't carry around, little mini computers and cell phones. So just in 5 years of change, to say nothing of 17. And I think the ESG focus is a classic example. The SAM-Pay focus is another example, and the diversity issue is a third example. I think this group, given how you polled, will be pleased to see our recommendations in that regard.
I mean, I want to talk about the whole project, but you jumped in a sense to someplace I did want to get to. And looking at the poll, I'm not surprised by the results of the poll, given who comes to these workshops. But with the diversity inclusion piece, particularly, you've really upped the expectations on that. I mean, before we've had the Ontario Securities Commission had said you have a comply or explain model. You have to have a policy on board diversity, report statistics around that, or explain why you don't. And you've, in your draft recommendation, said that's just not getting there. We need some targets. You're still leaving power in the hands of the board, but you're talking about targets, and I expect you've had pushback on that, or perhaps not. I don't know.
You're right. We have had pushback. Issuers, generally speaking, want as much flexibility, particularly when it comes to their boards, because turning over boards is slow. But you're 100% right. Comply or explain doesn't work. I pulled out a piece I wrote because I was at Teachers at the time and drafting their response to the first kick at this can. And the focus was only really on gender at that time. And, everything I wrote back in 2011 was absolutely true today. It was kind of sad actually to pull that out and read it. The focus is, I think our recommendation, we're planning to be bold. The panel is made up of 2 white women, a brown man, a black man, and 1 white guy. And it's the white guy who is actually saying, I've been CEO my entire career. That's what he's done. That's the piece he brings to the table, and the expertise of a number of different issuers. And he said, we need to have targets. So it's interesting. It's just there's debate over what the target should be, the length of time period for targets, all of which, there's a variety of different viewpoints, and none of which are 100% right and none of which are 100% wrong.
But you did go beyond just gender in saying, if we're going to get at this, it can't just be the debate about gender. We may as well just get right to the point.
Of course, and I think it would be, this is me speaking personally, I think if we came out with recommendations without something beyond diversity or something beyond gender, it would be completely tone deaf in today's environment.
Did you similarly get pushback when you start looking at things about ESG disclosure? Because in the recommendations, it talks about requiring issuers to report against the Task Force on Climate Related Financial Disclosures, or SASB, the Sustainability Accounting Standards Boards. We know there's been some recent push from big pension plans around that very same thing. So I think investors are pretty much behind that. That's easy, but they're not the ones producing the information. So this leads to one question: is this an idea as time has come? And secondly, how are you doing that balance between accountability, which was our theme today, and the burden on issuers?
Well, so speaking as a large issuer who is quite keen about all this, and you know, we like to think of ourselves as a bit of a thought leader. What an issuer like us is actually looking for is for guidance from the authorities as to which standard we're supposed to follow. And the irony that some of the pushback haven't we actually had one regulator who said they wanted to see this year what issuers were going to do before they decided. Well, that's a lot of cost. That's a lot of time, money, and effort if you're an issuer and you've picked the wrong standard. Yeah. And let me tell you, putting these frameworks in place in a company like ours, which has 22 businesses in 14 different countries, some communist, some emerging, some mature, is not an easy task. So I think actually issuers who want to, you know, report and want to be part of this discussion want guidance on what the standard is to be. Issuers who don't want to be involved in the game, I don't think, quite frankly, are going to succeed in the long run as companies that it will be successful. So I think definitely, I think it's time. My personal view is it's time it's come, and I think you're going to see some recommendations in the report.
Honestly, that's one of the first things we hear from companies too when we engage is this. It's not just, well, what you report, but is there a framework we should be looking at? Because there's a bunch of them and we don't know. It's not
And
reluctance to do it. It's just, we need to know.
which one. And the SASB fits better with some industries, although it relies on more on US data and US reports. So it's far more US focused, which may work better for some companies. The TCFD framework is a little more flexible, not as prescribed. So maybe in some respects is harder for issuers because it's not as prescribed, but it is more flexible. So there's pros and cons with both. But you know, speaking as an issuer, I would like some guidance.
But are you a bit worried that, you know, whatever, and again, speaking 2003 to 2020, that whatever you say now, this is an evolving area. There's all this talk about an IFRS type approach to this and
Sure.
merging of different systems. If you recommend something now, is it what happens in 3 years from now? Is it still going to be the right thing?
That's an excellent point. And we did talk about putting in a cogent kind of sunset clause, because what you don't want to, you know, think we're soothsayers in 2020 and we're getting right. And what we do know about the ESG space, it is evolving, particularly in the financial disclosure. It's quite laudable that we have comparable standards in a sector, so you can compare companies as to which is handling climate change management better, or incorporating it more into their business strategy. But right now we're nowhere near that. So it will be evolving. I'm sure in 5 years, we'll be talking about something slightly different.
And hopefully it won't take too many years to get back to an ongoing review of this. But so it's not just this in terms of evolving ESG space. In the general rule of capital markets regulation, Ontario, even within Canada, is not on its own. It is the biggest regulator, obviously, but it doesn't control corporate law in other provinces, even securities regulations. You know, there's the broad authorities and even potentially a common authority on that in time, we hope. But there's also the specter of what happens in the States, in the US and the SEC. So we're kind of playing a bit of a dance with regulation south of the border too.
Mm-hmm.
Where that came up to me in the report was the debate. There's a debate in the south of the border around regulating proxy advisory firms, and you echoed some of that in the draft recommendations in your report, that there was a concern that that proxy advisory firms should be regulated in some form around conflict of interest and other matters. We pushed back on that, so I wanted to raise it with you and just sort of sense what's the thinking there, what's the challenge?
Well, so I can speak to it. I personally have, so just a full disclosure, I've personally never been involved in this kind of battle with the proxy advisors, but we heard quite a few stories, and we know them to be authentic. So the conflict of interest is in one particular proxy advisor, both gives advice to investors like yourselves, but also sells governance consulting services to the issuers about which they are reporting. And, you know, what I've seen stories and seen the evidence where, you know, one side of the house is advising, making some advice based on supposedly poor governance or some situation at an issuer, and the other side of the house is trying to take advantage of that with the consulting services that the issuer needs to pay for. So it is a conflict of interest squarely between, you know, and you know, unlike a bank, which obviously has bank analysts analyzing all sorts of, you know, companies, including itself, there's no real structure around that. So we think that's a problem. The other problem that we heard of was the lack of opportunity for there to be a response by the issuer to some of the issues that are raised by proxy advisors. And so the proxy advisor can come out with recommendations and sometimes get the facts wrong. And the issuer is stuck in the position of trying to set the record straight to its investors and not really having an opportunity and as wide a you know, a framework that the proxy advisor has in its report. So those are a couple of things that we saw that from multiple stakeholders.
Yeah, and that was the debate carried out in the US as well at the SEC around, are there errors in proxy advisory reports? And frankly, there were, although the data from the States has said, you know, it's the range from the US Council of Institutional Investors, they looked at it and they said the range of factual errors in these is between 0.057% and 0.123%. It's a pretty small range given the thousands of votes that are being discussed in these reports. So I'm a little worried about that one going too far, that we regulate the proxy advisory firms in a way that I almost biases the information in the other direction.
I don't think you're going to find that. It certainly wasn't the intent. And I just would put to you, if you're the handful of companies caught in that small percentage, it can be devastating. It can be, you know, it can be bet the farm kind of issues. No, this is simply to provide the issuer, the company about whom the report is being made and a recommendation against, or whatever the case may be, an opportunity to respond. That's really, it's really as simple as that, as opposed to trying to, you know, shackle somehow the recommendation of the proxy advisor. That wasn't the intent. I don't think the recommendations will do that.
There's a concern, and we probably don't have enough time to get into it in any detail for this, but about the dominance in the market of two proxy advisory firms, and that the more complicated and technologically complicated you make it, the more difficult it is for other entrants. So still a concern on that one. We'll see how that plays out as the recommendations, just to maybe make clear, these are recommendations. They go to the Minister of Finance next, and
Yes.
then there's different regulators which have responsibility in different areas. So whatever comes of this, I mean, we hope that many of these things are get a wide audience, and then hopefully some of them get passed, and maybe ones we don't agree with don't get passed. We'll see how that goes, but there's still
right.
a whole process from this.
Yeah, you're right, Kevin. They are recommendations that this task force has put together, and then it's up to the minister to decide which, if any, of the recommendations Minister Phillips wants to put into place. But just to clarify, these are recommendations about Ontario's capital markets, to make Ontario as modern, to modernize the capital markets in Ontario. So to the extent that some of the recommendations necessarily will involve Ontario having to talk to other provinces, but of course, because of course we're a federation, particularly when it comes to securities regulation, that of course will be part and parcel of it. But our recommendations are just for Ontario.
And whether or not we get to the point of having a common national securities regulator or some form of that, this will, I mean, in a way, you have to be almost agnostic to that in producing a report like this.
We have been in support of it, but that wasn't the primary focus of it. It was to be supportive of it. If it happens, great. If it doesn't, we have to drive on and make Ontario, the best capital markets that we can.
Well, we've run out of time, but thank you so much, Melissa, for
My
giving us
pleasure.
that. And thank you for your work of all the people on the task force. This is really, I think, something very much needed, and I'm looking forward to the final report.
Well, thank you very much. And I really appreciate the audience today.
Great. Thank you. I'll pass it back to Effie. And
Thank you.
Thanks.
So thank you everyone for joining this fourth Share Religious Investor Workshop for 2020. A special thanks to our panelists and our guest, Melissa Kennedy, for sharing your insights and experiences. I do want to point out that the last time the regulations were updated was in 2003. And it wasn't until 2007 when the first iPhone was released. So you can only imagine what a different world it was back then. So thank you for sharing a lot of these insights and for your work on this task force. I also want to thank Damon Vanderlyn for managing the video conference technology and Amor Vertiflor for helping with registration and logistics. Those of you who have participated in past in-person workshops know that there are great opportunities for learning and meeting new people. And we hope the session has filled the gap amid pandemic restrictions. So we do look forward to meeting in person in future. We look forward to welcoming you back here in the workshops in 2021. If you'd like more information, please contact Share directly by email at info@share.ca. And an evaluation questionnaire will be sent shortly. And we want to make these sessions better, so your feedback will really help us be able to do that. Thank you very much and have a great day.
Thank you.